Welcome to Magnolia Bank Academy. My name is Dan Mason, and in this video, we're going to be discussing how credit scores work, why they matter, how they affect the interest rate you get, and probably most importantly of all, how to improve your credit score. So let's quickly start off with the basics. First of all, what is a credit score? Well, a credit score is a prediction of how likely you are to pay a loan back on time based on information from your credit reports. So as you may or may not know, you do not have just one credit score. There are three major credit reporting agencies: Equifax, TransUnion, and Experian, and each one will issue their own credit score. So when you're qualifying for a mortgage, lenders will pull a tri-merge credit report where we get the information from all three bureaus and we merge it into one report. So this credit report will have all three scores on it, and we take the middle of those three scores. Now, people ask me all the time, well, do you average the scores? No, we don't add them all up and then divide by three. We take the middle of the three. So, for example, if your scores are 645, 660, and 670, the score we'll be using to qualify is 660 because, well, that's the middle. But a lot of people ask, well, what if there's two people going on the loan? Which scores do we use? So let's say that borrower B has slightly lower credit scores. So I get that question every single day. Whose scores do we use? And Fannie Mae guidelines are pretty clear in that we take the lower of the two borrowers. Now, a lot of people argue that, hey, well, borrower A is the primary wage earner. They make the most money. They have the best credit scores. Shouldn't we use their credit scores? And man, I wish we could, but the guidelines are clear. It's the lower of the two. But what we can do in that scenario is we'll take a look and see if borrower A qualifies with their income alone. If so, then we'll do the home loan in their name alone. We'll put borrower B on title to the property. And that way, you get the best possible interest rate by using borrower A's high credit scores, and both people are listed on as owners to the property, and everybody's happy. So as I mentioned earlier, credit scores are indicators of risk. The higher your score, then the lower perceived risk you are. Makes sense, right? But credit scores and risk evaluation, it doesn't live in a bubble. It's not just your score. There are other factors like loan to value ratio that affect your perceived risk and therefore the interest rate you get. So how these factors affect the rate can vary by loan type. So let me explain. In our Mortgage 101 video, which you can access by clicking on the link below, we discuss the difference between conventional FHA and VA loans. So conventional loans are skewed towards A-paper borrowers, and they care about credit scores, like a lot. FHA and VA are much more forgiving and have minimal and sometimes no adjustment to the interest rate based on your credit score. So quite often an FHA or VA loan with a 640 credit score will get the same interest rate as someone with a 740 credit score. That is definitely not the case with the conventional loans due to something called loan level pricing adjustments, or LLPAs. So conventional loan guidelines are overseen by Fannie Mae and Freddie Mac. You probably have heard of them. And loan level pricing adjustments are how Fannie and Freddie assess risk. So it's pretty straightforward in that a high credit score with a low loan to value ratio, commonly referred to as LTV, is going to be low risk. So there's tons of equity in the property. The borrower has a high score, which means the borrower has a lot likelihood of paying on time. Thus, there's no loan level pricing adjustments, as you see here, because of the low risk. But as you can see, as the LTV climbs, the LLPA is increased because the risk is increased. Works the same way here with the lower credit scores. Even at a low loan to value ratio with a lower credit score, you can see that there's loan level pricing adjustments as a result. And by the way, these sample pricing adjustments you see here they're adjustments to points. They are not adjustments to interest rate. Don't let that percentage sign mislead you. These are point adjustments. So what I mean by that is, for example, let's say that somebody's in this quadrant here. They get a 740 score and a 60% loan to value. Let's say they get 5.5% to pull a number out of the air with 0 points. That same scenario, if we got a 620 credit score, we get that same 5.5% rate, but with a half point cost. Likewise, let's say that they had a 700 credit score, and let's say that we were going to 75% loan to value. They would get the same 5.5% interest rate, but with a 1 point cost. So if you don't know what I mean by points or how points work, please either watch our video on points or reach out to us at MBLending.mortgage, and we can prepare a custom scenario for you. So I think you get it now. Your credit score matters, and if you want the best deal, you need the highest credit score possible, right? But how do you get your credit score up? So if you ask 10 different people, you probably get 10 different answers on how to improve your credit scores. Some people will tell you, you know what, you got to pay your credit card balances down a little, and that'll get your credit scores up. Other people will tell you, you know what, pay off their collections. That'll do the trick. Others will tell you, you know what, talk to mom and dad. Get them to add you onto one of their accounts, and that'll boost your scores. I mean, yeah, you can take this kind of fire hose approach and just hope that spraying money across all these different accounts will help improve your credit scores. But really, there's a smarter way. So we have something that's called a what-if simulator, and it is a game changer. So we can play around with scenarios by asking the what-if simulator which accounts we need to pay down, which accounts we need to pay all the way off, or even occasionally which account balances need to go up. That's right. Sometimes adding a small balance to an unused credit score will actually increase your credit score. So you'd never really be able to figure this out on your own, which is why we have this tool. So the what if simulator allows us to really get surgically precise with your funds and maximize the score increase. So let me show you a real world example. So this is somebody's real world example where we needed to get them to a 620 or higher credit score. As you can see, they were starting off with a 606 credit score, and we had a couple of collection accounts to play with, a couple of revolving cards, and they had an installment loan. So we started playing around with the simulator to find that sweet spot for them. So we started with Pep Boys. We say, okay, this account is actually over its limit. Let's see if we pay this down below its limit. Let's say we pay this down to $400. Let's see what happens. You see, no change to the credit score. All right, well, let's say we pay it down to $200. Let's see what happens. Same thing, no change. All right, let's pay it all the way off. Let's see what happens. Same thing, absolutely no change to the credit score. So we could have wasted $570 paying off this Pep Boys account. It would have had zero impact to the score. Well, let's take another look. Let's look at this Rooms to Go account. Now we take this one. Let's say we pay this one down to $1,500. Same thing, no result. Well, let's see if we go to $1,200. Let's see what happens. There we go. Now we get ourselves to a 622 credit score. We're across that 620 threshold, but it's still just barely. Sure would like to have a little more wiggle room. So let's keep playing around. Let's say we pay this down to $600. There we go. Now we got a 626 credit score. We got a little bit of wiggle room. We're over that 620 threshold, and we've minimized the amount of money that we spent. Let's keep going. Let's see if we pay this thing all the way off. How high does the credit score go then? 626. No movement. So that's the sweet spot, right? Obviously, paying this one down to 600 is the best way to go. You spend the least amount of money with the most impact to your credit score. Now, we talked about collections earlier too, and again, we've got a couple collection accounts here. So let's say we went in, we say, let's get rid of those collections. Let's see what happens to your credit score if I pay those suckers off. Pay that one off to zero. Look at that, zero impact on the credit score. All right, well, obviously, if I get rid of both my collections, my credit score is going to go up, right? Nope, absolutely no change. So we would have wasted our money paying off those two collection accounts, and because it has zero impact on your credit score. Now, what's really interesting, let's say you paid those two collection accounts off, and then you also paid off Rooms to Go, pay that all the way down to zero. Look at that. Your credit score actually falls by paying down that Rooms to Go account. The sweet spot here is we need to have this account paid down to $600 and don't touch anything else. That spends the least amount of your money, gets you the most bang for the buck. So now we've got a specific plan, right? So now we know what we're dealing with. But you may be asking, how long is this all going to take to update? And the answer is, with a rapid rescore, it updates in only a matter of days. So you may or may not be aware that credit reports are backwards looking, and they typically run 30 to 60 days behind. So if you wait for it to organically update, it can be months before you see the results. However, with a rapid rescore, we can force the scores to update right away and see results in a matter of days. So here's how it works. Once you make all the changes that the what if simulator tells us to make, we simply get screenshots of your online accounts or maybe even letters from the creditors themselves documenting those changes. We then submit those documents over to our credit report provider for that rapid rescore. And then within 3 to 5 days, they issue a new credit score based on the information we provided. No more throwing darts and hoping your scores improve. No more waiting months to see results from your efforts. The what if simulator with a rapid rescore make it simple, fast, and efficient. That's the Magnolia way. So great. So we covered a lot of ground here, and now you most likely understand more than ever, really, that every credit profile is unique and every home loan scenario is unique. So there's really no one size fits all, and you really need experts to help you navigate this mortgage labyrinth to make sure you get the best deal for you and your family. So I hope you can walk away from this video with a better understanding of how credit scores impact your home loan, while also understanding that Magnolia Bank has the tools to get you into a great mortgage loan at a really great interest rate. So please be sure to check out all of our other videos on everything from getting pre-qualified to debt-to-income ratios to mortgage insurance, so you can walk into your next home loan with your eyes wide open. So again, my name's Dan Mason, and I look forward to showing you what we mean when we say here at Magnolia Bank, we have a personal way.